Hello, and thank you for coming to Home Buying Like a Pro. Today's guest
Can't hear
speaker.
you, Jeff.
Oh,
There you are.
hi. Thank you for coming to Home Buying Like a Pro. Our guest speaker today is Aaron Staufer. He's been in the real estate industry for quite a few years at this point and joined Elevations back in 2009. He has a breadth of knowledge, unlike many others, and we're very grateful to have him with us. So thanks for coming.
Awesome. Thanks, Kat. Beautiful. Well, thank you all for sharing your lunch with us. If you have questions, you can drop them into the Q&A function. Kat is going to go off. Name's Catherine. We call her Kat. She's going to go off screen. She'll come back on screen once she's aggregated a few questions. We love questions, so please bring them on. Nobody wants to hear me talk for the next 90 minutes. So please interject with your questions. It's always helpful. Your questions are going to be useful for not just me, but everybody else that's on here as well. So please ask your questions, drop in the Q&A function, and then Kat will aggregate them and she'll come back on. We'll field some questions and go from there. So as Kat mentioned, I've been in the mortgage industry now for 15 years. I got my real estate license directly out of college. So graduated college, immediately got into the real estate industry. And that was in 2008, which was like the single worst time to get your real estate license. In 12 months of real estate, I sold 2 properties. One sold for $26,000, the other one sold for like $76,000. So it was not great. I was actually about to switch careers entirely, and then I got recruited into lending. And I've been doing that ever since 2009. If you have a question, I will certainly have an answer for you. When I'm not doing mortgages, and I both originate loans for my own members, and I also coach and train and teach a panel of loan officers as well. But when I'm not doing that, I love to do soccer. I play soccer every week. I like to do yoga. I like to go for motorcycle rides. Very beginning of the pandemic, I bought a motorcycle with a sidecar, and I like to take my dog, Finian, Irish setter here, for rides. So if you ever see an Irish setter in a sidecar, that is me and Prince Finian, inevitably giving him a ride. So yeah, that's a little bit about me. Here's what we're going to be talking about today. Home buying like a pro is the largest topic we teach. It is really an overall picture of the home buying process, from very beginning, trying to figure out what your mortgage options are, to closing. What does the entire process look like? So it's a very deep topic. There's a lot of pieces we're going to be going into. When we talk about mortgage options, loan considerations, how lenders qualify for a mortgage ultimately, what is the pre-approval process? How does that get done? And then what's the home buying process look like? From when you want to start looking at homes to, again, going under contract and then ultimately closing, what does that entire process look like? So lots to get into. Please ask questions as you think of them. And then, yeah, we'll go from there. All right. So when you look at mortgages, there's ultimately 3 different buckets that mortgages fall into. The first bucket is what we call conventional financing. Conventional financing simply means that the investor behind the loan is Fannie Mae and Freddie Mac. Okay, that's all a conventional loan is. Those are loans that are backed by Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac offer the best loan terms, and objectively so, that's going to be the case. The second type of loan is what they would call a government loan. And government loan, they come in a couple different flavors. FHA is the most common, Federal Housing Administration. It used to be considered a first-time homebuyer program, but now it's really a low credit score program. Conventional financing typically wants to see like a 680 credit score. FHA will go all the way down to a 620. Okay, so it used to be a first-time homebuyer program. Now it's really a low credit score program more than anything else. USDA, U.S. Department of Agriculture, properties that are in rural areas. And then VA, Veterans Affairs. So these are truly Uncle Sam's money. These are truly government loans. Conventional loans, Fannie Mae and Freddie Mac, are government-sponsored enterprises. They used to be completely different from the government. They didn't actually have any connections to the government until the housing bubble popped in 2007, 2008, and the government said, we can no longer trust you. So you are now going to come under the umbrella of FHFA, Federal Housing Finance Agency. So FHFA is the overall umbrella. Fannie Mae and Freddie Mac are the components of that umbrella that make up the vast majority of mortgages. The third type of loan is what we call portfolio loans. Your car loan is a portfolio loan. Credit cards would be a portfolio loan. It's anytime that you are using the institution themselves, Elevations Credit Union or bank's own personal money. To that end, they get to decide what their rates are, what their costs are, as well as what their guidelines are. With conventional loans, we're adhering to the conventional guidelines. It's Fannie Mae and Freddie Mac setting what those limitations are, and it's our job to make sure that you fit inside that threshold, okay? We're going to be spending most of our time today talking about conventional guidelines. It's objectively so the best type of loan, and the vast majority of borrowers are going to fall into it. So we'll be spending the majority of our time talking about conventional. I'll point out a few instances where another loan may have some advantages or disadvantages as well. Within each of these three types of loans, there's various different mortgage options, okay? The most common mortgage option is a fixed rate mortgage, okay? That's your 30-year fixed, your 20-year fixed, 15-year fixed, 10-year fixed. With all of those loan options, the principal and interest, the mortgage part of your mortgage payment is going to be fixed for the entirety of the loan. Another loan option that's quite common right now is what we call a hybrid adjustable rate mortgage. Adjustable rate mortgage, ARM for short, like your arm attached to your body, okay? ARM's got a rather bad reputation during the housing crisis. They were overused, and they also had a lot of quirky loan features, okay? So yesteryear's ARMs, they would oftentimes have what they call negative amortization, which is where you could make your typical monthly payment, but if you made an optional less payment, they would simply add on years to your loan. So a 30-year loan would become a 31-year, 32-year, 33-year loan. What could go wrong with that? They also did not have limits as to how high they could increase, nor did they have an initial fixed period of time where the rate was actually fixed. And oftentimes they also had what they would call a bullet feature or a balloon feature, which is where partway through the loan term, the remaining balance of your loan would come due in full. So no limits on increasing, negative amortization where they add length of years to your loan, no limits, either yearly or overall. There was a lot of issues that occurred with them. Today's ARMs are drastically different. So today's ARMs are what we call a hybrid ARM, which means that they have an initial period of time where the rate is fixed. So you'll see it called like a 3-year or 5-year ARM. That is a rate that's fixed for 3 years or 5 years, and then it's subject to change. 7-year or a 10-year ARM would be fixed for 7 years or 10 years, and then it's subject to change. They also have limits as to how high they can increase. So the 3 and 5 year for us, it's a 2-1-5 format, which means it can adjust 2% at a first adjustment. So starting in year 4 if you did a 3-year, or starting in year 6 if you did a 5-year. They can increase 1% each additional adjustment every 6 months to an overall limit of 5% above your initial rate. Okay, so they do now have limits. They also don't have a negative amortization anymore. You cannot make an optional less payment. Your payment is what it is. There's also no balloon payment or prepayment penalty with any of these loans. So today's version of an ARM is drastically different than what it was pre-housing bubble, pre-Great Recession. Okay, 7-year, 10-year, 5-1-5 format, which means 5% the first adjustment, starting in year 8, starting in year 11, 1% each adjustment after that, 5% overall. Okay, how those ARMs adjust, they're going to look at what they call the index. Lenders used to use what they call the LIBOR index. Now they use Staufer, S-O-F-R, Standard Overnight Financing Rate. That is the newly established index that lenders are going to use to base your rate on. They're going to look at the 30-day average of that index and then add a margin to it. The margin is for us 2.75 that we'd add to the loan. Why would anybody look at an ARM? Well, the reason they're so popular right now is because rates are high. When rates are low, you don't really have a cause to look at ARMs. But when rates are high, it's worth at least looking at to possibly see if you can get a better rate, save yourself some money. The other reason you might look at an ARM is if the expectation is that rates are going to drop in the future. So right now, rates are high. The expectation is that rates will come down in the future. And when they do, you're going to be refinancing. So if you're not going to have that loan for a long period of time, if you're going to be refinancing in the near future, why not take advantage of a lower rate in the meantime? And then lastly, another reason somebody might look at an ARM is if they're simply not going to be in the house long term. We see people here on work visas all the time. They legally have to be out of the country within a certain period of time. Great. Take advantage of an ARM, take advantage of a lower rate in the meantime. Or if you're buying your first home and you're like, I'm simply not going to be here long term. Maybe this is a 3-year home for me. Great. Well, let's do a 5-year ARM, take advantage of a lower rate again while we can. So that's why some people might want to entertain an ARM. Yeah. Kat, you already got a question. Great.
Yes, I do. So the question is, does a 3-2-1 buy down mortgage fall into this?
Yeah, 3-2-1 buy down. So I'm glad they mentioned that. Buy downs are not something that I have as part of this seminar, but we can certainly have that conversation. Okay. So short answer is it's separate from this, but you can do it with regards to any loan program. Okay. So when it comes to rate buy downs, there's both permanent buy downs as well as temporary buy downs. A permanent buy down is you pay higher upfront costs and you get a lower rate. Whenever it comes to a permanent buy down, I have to figure out how much is it going to cost you? So what's that upfront cost to get that lower rate? How much are you going to save on a monthly basis? And therefore, from there, how long do you have to have that lower rate to come out ahead? Okay, so permanent buy down is you pay higher costs, you get a lower rate for the length of your loan. Permanent buy downs are very common when rates are high. It's also my opinion that that's actually the worst time to do it. So here's my logic there. When rates are high, you're still going to have a break-even point. Yesterday, when I was crunching the numbers for somebody, the break-even point on paying discount points, buying down the rate, it was like somewhere along the lines of 4 years. Well, when rates are high, you're not likely to have that loan for 4 years. You're very likely going to be refinancing that loan within the first few years. If that's the case, you would have spent more money, discount points, paying the extra cost, and you wouldn't have reaped the benefit of it. You wouldn't have recouped those costs via that lower monthly payment. So when rates are low is actually when you want to do a permanent buy down. That's when you're more likely to have that loan long term. People always ask about it when rates are high because they just want to get their payments down, but it's not necessarily the best time to do it. When rates are low, you're more likely to have that loan long term, but it's also when people don't think about it. You go, rates are low, I'm happy, I don't have to stress about it. So that's a permanent buy down. Pay higher costs, you get a lower rate for the life of your loan. A temporary rate buy down is what the member was just asking about. Temporary rate buy down is where there is still an upfront cost, but your monthly payment is going to be reduced for the first 1 to 3 years. They come in a lot of different flavors. 2-1 buy down is the most popular. With a 2-1 buy down, your rate is 2% lower the first 12 months, 1% lower the second 12 months. A 1-0 buy down, 1% lower the first 12 months, 0% lower the second 12 months. Or a 3-2-1 buy down, as the member mentioned, 3% lower the first 12 months, 2% lower the second 12 months, 1% lower the third 12 months. So that's a temporary rate buy down. Your rate is temporarily reduced for the first few years. Temporary rate buy downs are really popular when rates are high, as they currently are. When the expectation is that rates are going to drop in the near future, which they are, and if you have somebody that's willing to pay for it for you. Okay, so we really see them more in balanced markets. When we're in a seller's market, well, the seller gets to dictate more of the terms, and we're currently in a seller's market. Seller's market, seller gets to dictate more of those terms, and they may or may not be willing to pay for a temporary rate buy down. They're great if you can get them. It's entirely part of the negotiation process. And you really have to find a house where a seller is amenable to it. It doesn't make sense for you to pay for your own buy down. It'd literally be us taking your money, setting it aside for you, and then supplementing your mortgage payment with that money. That doesn't make a lot of sense. Unless you don't trust yourself. If you trust yourself, you can just deal with it on your own. So yeah, it's a great option if you can get it. It's always part of the negotiation. And then we do see them more when it's a more balanced market. We're seeing them occasionally right now, but it's still up to the negotiation. And if it's you or somebody else and you're offering the exact same offer, but you're asking for them to pay for a 2-1 buy down or a temporary buy down, you're probably not going to get it. They're probably going to go to the other offer where they're not asking for that kind of concession. It's a great question. Love it. Keep them coming. Love questions. All right. So when you get pre-approved for a mortgage, and that's what we're going to be talking about in this next kind of section of slides. So when you're looking to qualify for a mortgage, lenders look at what we call the 3 C's, okay? First C is collateral. It's the property that you're buying, okay? Unlike buying a car, the lender actually cares about what you're buying, okay? When you're buying a house, the lender cares about what you're buying. Anything 1 to 4 units, single family, condo, townhome, duplex, triplex, or fourplex is all within our realm of expertise, okay? If you're looking at more than 4 units, 5plex or above, an apartment complex, whatever, or you're looking at vacant land, that's going to be a completely different department. And everything we're talking about is not going to be relevant there, okay? So collateral is the first C. Second C is credit. Credit, we're going to be talking about that next. And then third C is capacity. Capacity is related to 2 different components. First component is your debt to income ratio. Second component is your down payment. We're going to be talking about credit and capacity going forward. So let's talk about credit. I think people love their credit scores. After college, you don't really get grades in life anymore. I feel like people think their credit scores like they're great in life. When mortgage lenders look at credit, we look at 5 different pieces of your credit, okay? The first piece, and it makes up 35% of your score, is your payment history. Simply put, have you made your payments on time? If you've made your payments on time, you're current, you've stayed current, you've never gotten 30 days late or more, you're going to have a good credit score because 35% of your score is simply the payment history. So pay your bills on time. Even if you have like an optional minimum payment, you're much better off paying that optional minimum payment on time than paying the full amount a month later and having it be late. Always make your payments on time if you can. 35% of your score, huge chunk of it, makes a lot of sense. Past performance indicates possible future success. That's kind of the logic with credit score. So 30% of your score, this is the one that's the most intriguing to me. It's the most misunderstood piece of your credit score. So it says amounts owed. What it really should say is amounts owed relative to the amount you could owe. Kind of complicated. What do they mean by that? Specifically credit cards, okay? You want to keep your credit card balance to limit ratio. So how much you owe versus how much you could owe on that credit card to 30% or less. If you have a credit card limit of $1,000, you want to make sure you're not utilizing more than $300 on that account. It's kind of crazy. Nobody tells you about that when you get a credit card. But you really want to keep your balance to limit ratio at 30% or less. Second, you go over 30% of your available limit, your score is going to start to drop. If you go over 50% of your limit, your score is going to plunge. So if you ever notice like significant variability in your credit score month to month, it almost always has to do with this. Balances related to the limit on your card. Now, a lot of people say, well, I pay off my credit card in full each month. I use my credit card throughout the month, and then I pay it off in full when the bill comes due. Whenever that bill comes due, whenever that bill generates, that's the information that gets passed along to the credit bureaus. So if you're like most people and you don't pay your bill until the bill comes due, it's already too late. That information's already been passed along to the credit bureaus, okay? That information's already passed along. So if you rack up a balance throughout the month, that information is what gets passed along. Whatever's on that credit card statement is what makes its way to TransUnion, Experian, and Equifax, the 3 credit bureaus, okay? So if you want to get ahead of it, you could pay your bill early. Hey, great, my credit card statement generates on the 1st of the month. Great. If you were to log in and pay your bill on the 25th of the month, the prior month, now when that credit card statement generates, it's going to show $0 balance, $0 payment. That's the information that gets passed on to the credit bureaus, and you're going to notice an improvement in your credit score. Very easy way to improve your credit score is to simply pay the credit card bill before it comes due. Set a calendar reminder, pay it before it comes due. This especially becomes tricky when you have a really small limit on your credit cards. Kohl's cards, store cards are very, very common to have the same issue coming up. What they'll do is they'll give you a credit limit of like $300. Well, great, $300. You go to the gas station once, you're going to be over 30% of your limit. So if you're in that situation, possibly look at increasing your credit card limit. If you increase your limit, you might notice an improvement with your credit score because it's going to be harder to use more than 30% of the limit at that point. It's really easy when your limit is low. If your limit is higher, it's going to be trickier to do. You have to trust yourself. You have to trust yourself. So just like the buy down, you got to trust yourself. But keep that in mind as well. It's a very easy way to improve your credit score. 15% of your score is length of credit history. If you've ever heard people say, hey, don't close out any credit cards, that's what they're referring to, okay? Whenever you close out a credit card, it reduces your overall length of credit history. Now, credit cards tend to be the single best thing you can do for your credit score. They also can be the single worst thing you do for your credit score, okay? But length of credit history, credit cards tend to be your oldest trade line. Car loans are finite, 5 to 7 years typically, right? A mortgage is finite. You're going to be refinancing or paying off the house or selling the house down the line. Those are finite in nature. Student loans, theoretically, those are finite, although that might not feel like it. Credit cards, great. Credit cards are going to be your oldest account. Whenever I pull credit, their credit score is significantly weighted by the length of that credit history. And the credit card is going to be that oldest account typically. I've seen some people whose credit I've pulled recently where they had a card open since the 90s. Every single time they issue you a new card, that's fine. It's still tied to that same account number. It's still tied to that same trade line, okay? So keep that in mind, length of credit history, 15%. You want to keep your credit cards open and active. If you have 5 credit cards and you're like, look, I need to close out some credit cards, from a lender's perspective, from your credit score's perspective, closing out the newer accounts would be better. Keeping your older accounts is going to be more advantageous from a credit score standpoint. 10% of your score is new credit. Now, that's really 2 different pieces, okay? Anytime you get a new trade line, a new account, new credit account, it's going to drop your score for about 6 months. So it will negatively impact your credit score for about 6 months. So that's one part of that is new credit. Great. Any new account going to drop your score for about 6 months. After 6 months, it will start to benefit your credit score. Okay. So it's a very temporary component. After 6 months, it's going to start to add to that length of credit history and will start to help you out. But for the first 6 months, expect a dip in your credit score. The second part of new credit is, has anybody checked your credit? Okay, that's called inquiries, credit inquiries. If you ever hear the people say, well, you don't want to have too many people check your credit, you want to keep your credit inquiries to, keep those down. That's what they're referring to. Any single time a lender pulls your credit, it's going to drop your score between 3 and 5 points. It's going to affect you for about 90 days. Now, there is 2 exceptions to that. If you're shopping for a car, you're going to have multiple car loan lenders check your credit within a 14-day window. It's only 14 days, and it'll only count as 1 inquiry. Same thing with a mortgage. It works for car loans, it works for mortgages. If multiple mortgage lenders pull your credit within a 14-day window, it still only counts as 1 credit inquiry. Okay, so keep that in mind. It does not work for credit cards. It does not work for personal loans or student loans or anything like that. They assume if you have multiple credit card lenders pulling your credit within a 14-day window, you're trying to get access to multiple credit cards. Okay, so keep that in mind. It only works for car loans. It only works for mortgages. But 14 days, multiple inquiries of the same type on those 2, it only counts as 1 inquiry. And then lastly, types of credit use. 10% of your score is the makeup of the trade lines you have. Theoretically, emphasizing theoretically, okay? Do not do this. I'm not even recommending you do this, okay? Theoretically, you should have 3 credit cards for every 1 non-credit card. So if you've got a car loan, a student loan, a personal loan, you should theoretically have 9 credit cards. Don't do that. It's overkill. You can certainly have perfect credit without it. But credit cards are the single best thing you can do for your credit score. They show a level of discipline that non-credit cards don't show. Credit cards, you have to manage a limit, you have to manage a balance, you have to manage payments. They're not typically set up on auto pay. You have to actively manage it. All those other installment loans, car loans, personal loans, student loans, you just set them up on auto pay and you set it and forget it, right? So credit cards do require a level of discipline that non-credit cards do not. Because of that, credit cards are the single best thing you can do for your credit score. Kat, another question before I get into some adverse credit things.
Absolutely. So this question is, will a home loan also drop your score for 6 months?
Yes, it will. Absolutely. Any new trade line, credit cards, car loan, student loan, personal loan, mortgage, it'll drop your score for about 6 months. After 6 months of reporting, it'll start to improve your score. So yes, short answer is yes. All right. So as I mentioned, when we're looking at these 3 different buckets, conventional financing typically wants to see a 680 credit score. Government financing will oftentimes go down to a 620, sometimes even lower. Portfolio loans, since it's the bank or credit union making up their own guidelines and rules, they get to decide what that limit's going to be. Okay, so this is typically plan A, plan B, and then plan C is, we don't meet any of these other 2 guidelines. Let's start to see if we can make sense of this loan on our own personal books. Okay. Now, beyond just the credit score, and lenders are going to use FICO Model 8. So if you're signed up for Credit Karma, they're not reporting your FICO Model 8. They have their own algorithm they use to calculate credit scores. FICO Model 8 typically ranges from a 350 to an 850 for credit score. Anything over 780 is going to be perfect. Anything over 680 is going to give us access to the best loan terms. Anything below 680, we're going to be looking at an alternative type. But besides the credit score itself, lenders also care about a few different things. So late payments. Number 1, get current. Get current. You don't necessarily have to get current before you apply for a mortgage. I wouldn't let that hold you up, but get current if you're not current. We don't see a lot of this. Typically, people are current on their debts before they come apply for a mortgage. Collections. One of the changes with FICO Model 8 is they reduced the impact that collections have on your credit score. They were finding that collections were so prominent and so common that they had to actually reduce the impact that collections had. You know how every single time you go to the doctor, they verify your address? That's because medical collections are so common. They've kind of gone crazy. But medical collections are extremely common. If you do not pay your bill on time, they immediately, without any hesitation, report you late to the collection bureaus. Collections do not typically have to be paid off prior to qualifying for a mortgage. Now, it does depend on how much you have owed on collections. If it's a couple $100, not a big deal. We can keep proceeding with a mortgage, close on people all the time with collections outstanding. If it's in the several thousands of dollars, typically $3,000 or more, there's a good chance that collections would have to be paid off prior to closing. It depends on the makeup of your file as a whole. Sometimes I'd be surprised that they don't require it, but oftentimes they will. Charge-offs. So a charge-off is you owed a creditor money for so long that they gave up trying to collect it. Okay. They gave up trying to collect it and they charged it off their books. They literally wrote the charge off on their books. They have their gains, they have their losses, they just took the loss. Okay. Yay, you fought the law and you won. Congratulations. However, it's going to continue to drag down your score for years. I've seen it on there for up to 10 years. So charge-offs, while you may have fought the battle with the creditor, they're going to continue to drag your score down for up to 10 years. That's kind of rough. Charge-offs don't typically have to be paid off. They typically fall in the nature of collections, which means it depends on how much is owed. To require whether or not it's going to be needing to be paid off prior to closing or not. So we don't typically have to see collections or charge-offs paid off unless it's, again, the several thousands of dollars. And then there's a very good chance it would have to be paid off. Okay. Judgments. Judgments always have to be paid off. No questions about that. Judgments always have to be paid off. All these loans are backed by the government in one way or another. Fannie Mae and Freddie Mac are government-sponsored enterprise. FHA is truly Uncle Sam's money, Federal Housing Finance Agency, right? And then portfolio loans, we're backed by NCUA. We're backed by NCUA. That's a national entity. So all lenders are backed by the government in one way or another. Judgments are you legally owe somebody money. And the government does not want you going and getting a mortgage or having them back a mortgage if you legally owe somebody money. We typically see judgments with unpaid taxes like tax liens or maybe outstanding child support payments or spousal maintenance payments. Those are very common as well. You lost a lawsuit and you legally owe somebody money. All those are going to have to be paid off, settled up before you can possibly go get a mortgage. So that's your credit. That's what makes it up. That's the credit score we need. And those are the adverse impacts that do matter beyond the credit score itself. Let's talk about down payment. So if you're a first-time home buyer, which is defined as anybody who has not owned a house in the last 3 years, the minimum down payment on a house is going to be 3%. Okay. If you are a repeat home buyer, so you have owned a house in the last 3 years, the minimum down payment is going to be 5%. So 3% is a first-timer, 5% down if you're not a first-time home buyer. Okay. Now, a term we're going to talk about a lot here is loan to value, which is simply your loan amount divided by the value of the property that you're buying. Okay. The contract price, most likely. Now, if you've ever heard you have to put 20% down, they're saying you have to put 20% down to avoid unnecessary insurance. That's called mortgage insurance. Mortgage insurance, MI, private mortgage insurance, PMI, or sometimes you'll see it called MIP, mortgage insurance premium. They're all the exact same thing, okay? Insurance you pay for that does you absolutely no good, okay? It's not for your benefit. It's insurance you pay for that actually protects the lender. Anytime you put less than 20% down, it's going to be a necessary evil. Okay. Now, with a conventional loan, and one of the many reasons I talk about it being the gold standard for mortgages, your mortgage insurance is on a sliding scale. The more you put down, the less it's going to be. Also, it's temporary in nature. We're going to be looking at a few ways to get it removed in just a couple slides here. Okay. I mentioned that because with an FHA mortgage, which is kind of our low credit score program, with an FHA mortgage, that mortgage insurance is fixed. Regardless of how much you put down, it's fixed. You have to pay for both monthly and upfront mortgage insurance, so it's doubly expensive. That insurance policy you don't want, that you really don't need, yeah, you have to pay for it twice when you get an FHA mortgage. And also with an FHA mortgage, that monthly premium is permanent. You are stuck with it forever. If you put 10% down, you have to have it for 10 years. Like FHA, objectively so, because it's just a mortgage insurance component, is not our favorite option. It has its place in the world. It certainly does. But it's not just not our favorite option. The government intentionally doesn't want to do them. They've made their costs significantly more because they want to push people more towards conventional financing or portfolio financing. The government used to do tons of FHA mortgages. It used to be a great program. In fact, it had the least down payment program for a while. There's a lot of ways to get mortgage insurance removed with an FHA mortgage. That is no longer the case. They've made their loans intentionally somewhat cost prohibitive, trying to push people towards alternative loan programs. With a conventional mortgage, though, like I said, the mortgage insurance is on a sliding scale. So for every $100,000 in loan amount, not sales price, but loan amount, your mortgage insurance is going to be as follows for a 740 plus credit score. Okay. So $690 per year per $100,000 loan amount if you did 3% down. With 5% down, it's $440 per $100,000 loan amount per year. So if you were getting a $300,000 mortgage, multiply all these by 3, divided by 12 to come up with your monthly premium. Again, with conventional financing, you either pay it monthly or upfront, but not both. FHA, you'd have to pay it both. Okay. Now, this will depend a little bit on a couple other pieces. Your debt to income ratio does matter here. What I put on here is what we know we can get it. There's a very good chance it's actually even going to be less. We shop around mortgage insurance 3 different times during the process. Once when you're under contract, once when we get the appraisal in, and then again right before closing. We want to make sure that you're getting the cheapest mortgage insurance policy that's available. All the mortgage insurance companies offer lenders the exact same coverage. It's actually government mandated. They all offer the lenders the exact same coverage. So it's not like your car insurance or your homeowner's insurance, where it's going to vary company to company, as well as what the coverages are. When it's a conventional mortgage, all we care about is getting you that cheapest policy. So we will shop it around multiple times during the process. It's incredibly important to us that you get the best deal with regards to mortgage insurance, especially with rates where they are. Like whatever we can do to save you a little bit of money, we're going to do. So that's mortgage insurance for you. It's also temporary in nature when you get a conventional mortgage. And with the conventional mortgage, you can have it removed in 4 different ways. Okay. Number 1, it'll fall off when you are scheduled to reach 22% equity. 22% equity means 78% loan to value. Okay. Now, 78% loan to value based on the original value. That is the worst case scenario. That is you fall asleep at the wheel. Okay. You make your payments on time, you fall asleep, you set it up on auto pay, you forget about it. It'll fall off when you're scheduled to reach 22% equity. If you're doing like 5% down, it's very common that that's like 10 years into the transaction. So it's going to take some time. That's why it's the worst case scenario. Set that aside. Don't worry about that. Almost nobody has that happen. There's 3 other ways to get it removed. Number 2, when you refinance, if you have 20% equity in the property, you're not going to have it on the new loan. That's more relevant now than it usually is because there's a very good chance you're going to be refinanced in the future. And when you refinance, if you have 20% equity, so your loan to value is 80% or less, you're not going to have it on the new loan. That one's kind of obvious, but it's also going to be pretty relevant. There's a lot of people that are going to be refinanced in the future given where rates are at. Number 3, within the first 2 years, if you actively pay down your loan, okay, if you reach 80% loan to value based on the original value, you can request to have it removed. Now, there's a couple things here. Number 1, original value. Within the first 2 years, they will only use what you originally acquired the house for. They will not use what your house is worth. Okay, so they will not take into account any appreciation within the first 2 years. Number 2, on request at lender's discretion. What does that mean? It means you're going to have to pay for an appraisal. Okay, we have to have you pay for an appraisal. Make sure the house has not gone down in value any. Okay, even though we can't use appreciation, we need to make sure the house has not gone down in value any. We come across this where somebody might be selling a house and they're receiving a chunk of cash and they're going to be paying down their loan, or people receive an inheritance, or people just actively attack their mortgages. If you reach 20% equity, 80% loan to value based on the original value within the first 2 years, we can petition to have it removed. And number 4, and by far and away the most common route, okay? After 2 years, you can petition to have it removed based on appreciated value. So within the first 2 years, original value. After 2 years, they can use a new value. Again, at lender's discretion, which is code for, gonna have to pay for an appraisal. And since it's an insurance company, and all insurance companies, regardless of the industry they're in, want their money, they're gonna require you of 25% equity, okay? So 20% equity based on the original value within the first 2 years. After 2 years, 25% equity, but they will use a new value. That's a very common route. You put 5% down, your value of your house would have to increase 10% each year for the first 2 years to get that point. You might not hit that. 10% appreciation is pretty significant, but you might hit it after 3 or 4. Or again, refinance if you have 20% equity, not going to have it on the new loan. So just keep that in mind. Conventional loan, mortgage insurance is temporary. FHA, mortgage insurance is permanent. All right, so what are the sources of down payment? Talked about credit. Now we're talking about capacity. Capacity is down payment and then debt to income ratio. Okay, so down payment. Ultimately, you want your funds in either a savings, checking, or a money market account for closing. You don't have to have it in one of those accounts to apply for a mortgage. Don't worry about that. But prior to closing, you're going to want your funds available in a liquid account. Liquid accounts are extremely important because the funds are either going to have to be wired or get a cashier's check for the cash to closing. Okay, so you're going to want your funds ultimately in one of those 3 types of accounts, at least prior to closing. Okay, if not at the very beginning, not a problem, but at least prior to closing. You can certainly use retirement accounts for down payment money. How much you can get access to, what the terms are going to vary pretty drastically depending on 1, the type of account, and 2, who the money is being held with. Okay, so let's talk about 401ks. 401ks, you can typically take a hardship loan from your 401k and use that money as a down payment on a new house. Now, hardship loan, the government will typically allow for 2 criteria to meet a hardship requirement. 1 is divorce, certainly going to be a hardship. 2 is buying a house. I don't know why buying a first-time home is considered a hardship, but the government says it is. You can take a loan from your 401k. With that, you borrow your money from your 401k, and then you pay yourself back with interest. It's not a bad deal. You're borrowing your own money, you're paying yourself back with interest. Ironically, people talk about all the downsides of 401k loans, but the people I see do it the most tend to be CPAs or wealth management advisors. They know they have access to the money. They know that they're disciplined. They feel like they're comfortable withdrawing their own money. Make sure when you're looking at a 401k loan, ask your wealth management advisor, how much do you have access to? What are the terms of repayment? And this last question is commonly ignored, but you really need to ask it. Do I have the ability to contribute to my 401k while I'm repaying the loan? A lot of 401k providers will say you cannot contribute to that 401k until the loan is repaid. They'll still take money from you each month from your pay stubs, but instead of going towards new contributions, it's simply going towards paying down the loan. I only mention that because if you're buying like a rather nominal amount, a couple $1,000s, whatever the case may be, I'm not really concerned about it. But if you're withdrawing, $25,000, and it's going to take you multiple years to pay that loan back, it's going to be multiple years before you can contribute back to your 401k. And if you're young, time is the best ally you have when it comes to retirement contributions. So you want to make sure you're not, robbing Peter to pay Paul or cutting off your nose to spite your face, right? So make sure you're asking those questions in advance. They're extremely important. You want to know exactly what you're getting yourself into. How about Roth IRAs? So with the Roth IRA, you've already paid taxes on the money. You paid taxes on the money you've invested it into a Roth IRA. With the Roth IRA, you can withdraw the principal, the amount of money you've contributed to that account. You cannot withdraw the amount that your money has made. So if you contribute $5,000 to a Roth IRA and now it's worth $7,000, you could access the 5, but not the 2, okay? Principal, $5,000, you can access that. You've already paid taxes on it. No limitations, no penalty. You can access the money right away. The money your money's made, you cannot access, okay? So Roth IRAs are in one way more lenient, in another way less lenient. IRAs are much more tricky. IRAs are much more tricky because with the 401k, you're typically contributing to that 401k typically. You might not have rolled it over just yet. You might not have access to the account anymore. But with most 401ks, you do. With Roth IRAs, you don't. You've rolled it over from a 401k into an IRA, and you are no longer actively contributing to that IRA for the most part. And it's not always the case, but usually, okay? So it's going to be harder to repay a loan. Ask your wealth management advisor, do I have access to any money without penalty? How much do I have access to? What are the terms of withdrawal? It's going to be a little bit trickier with an IRA. It's going to be more easy with a 401k or a Roth IRA. What about non-retirement accounts? Stocks, bonds, mutual funds, non-retirement, like a brokerage account. You can absolutely use that money for closing, perfectly fine. We will have to show proof of liquidation, proof of moving that money over from an invested account into a non-investment account prior to closing, but you can absolutely use that money for getting qualified and buying a house. Gift funds. Gift funds are perfectly fine. Has to be a gift. So you and the person doing the gifting, what we call the donor, will sign a letter saying, this is a gift, not a loan. We do not expect repayment. We also have to show the transfer of the funds occurring from their account into your account. So we have to show that actual transfer occurring as well. Has to be a family member or a family-like relationship for a conventional loan. Familial-like relationship. So ex-spouses would qualify, fiancés would qualify, adopted children would qualify as well. All of those are perfectly fine and considered familial-like status. Otherwise, direct family members are perfectly fine as well. Lastly, loans against an asset you own. 401k loan, we've already talked about one of those. You have your 401k, you can take out a loan on that 401k and use that money to buy a house. You can also get a car loan. If you have a car and you don't have a loan on the car, you could actually take out do a cash out refinance on that vehicle, take that loan and use that money to buy a house. I do have to take into account that new payment when I'm qualifying you for a mortgage, okay? Which gets us to debt to income ratio, okay? When we get you pre-approved, we're gonna go over credit, we're gonna go over your collateral, what kind of properties you're looking at buying, and then we're gonna look at your capacity. How much do you have available for a down payment? And ultimately, what's your debt to income ratio? Debt to income ratio is typically what's going to limit most people's ability to buy a house. Not always the case, but most common. So debt to income ratio, also known as DTI, debt to income ratio. So when we calculate your debt to income ratio, we're going to start with calculating your monthly gross income. So before deductions, before taxes, before any of those expensive 401k contributions, any of that, what is your gross wage? Okay, prior to all those expenses, prior to taxes, what is your gross wage? We want to figure out the gross monthly wage. Then we're going to multiply that by either 35% if you are fiscally conservative. So no election year, not talking politics, fiscally conservative, okay? Or 50% if you're more aggressive. Why would somebody might go 35 versus 50? If you're the type of person that doesn't really spend a lot of money and your home is your idea of a vacation, you're just kind of a homebody. If you don't have a lot of expensive hobbies, if you don't have any children, or if maybe you're on the beginning of your income growth curve, Hey, I'm in an entry level position. I know my income's only going to go up. Great. You might feel more comfortable with a higher debt to income ratio. If you are nearing the top of your income level, or you do have kids, or you do have like to travel, or you do have a lot of expensive hobbies, you might want to stay closer to like the 35% range. Okay. So monthly gross times 0.35 or 0.5, you're more aggressive. Then we're going to subtract out any monthly debts that show up on your credit report. That's going to be your car loan payments, your student loan payments. If your student loan is not in repayment, we have to calculate a payment, typically at either 0.5% or 1% of the balance on that student loan to come up with a payment. That can get extremely expensive. Okay. Credit cards. We just care about the minimum credit card payment. Whatever that minimum payment is on your credit card statement that you got, that's the payment that's going to be reflected on your credit report. That's the payment we're going to factor into this. I mentioned in the previous slide, loan against an asset you own. If you go get a car loan and we use that as a down payment on a new house, I have to factor in that new car loan payment when I qualify you for a mortgage. Okay. So monthly gross, 0.35, 0.5. Subtract out any monthly debts that show up on your credit report. The only thing else I have to subtract out that does not show up on your credit report is child support payments or spousal maintenance payments. Okay. Child support or spousal maintenance, those don't show up on the credit report. I do have to take into consideration. When I do all that, whatever remains is the max housing payment I can use to qualify you. Okay. So we do that equation, we're going to come up with a monthly number. That is the max payment I can qualify you for on a monthly basis. Home buyers like to think about qualification with regards to sales price. Lenders like to think about it in regards to monthly payment. Once I figure out that monthly payment, though, I can figure out what sales price that's approximately going to equate to. Okay. That's exactly what we do when we get you pre-approved. You call in, you want to get pre-approved. This is the exact calculus we do. Now, beyond your typical monthly debts, we also have to take into account a couple other things that are going to matter to you. Okay. Maintenance and unexpected repairs. If you're currently renting and you're going to go buy, you have to start planning on having those things paid for by your own personal being, right? So maintenance and unexpected repairs. There's a common rule out there that you'll hear where you're supposed to set aside 10% of your monthly housing payment each month for unexpected repairs. Like any of those kind of rules, they're flawed a little bit. Okay. So 10% might be sufficient if it's, a home that was built in, 10 years ago. But if your house was built in 1910, you might have to set aside more money than 10%. Okay. Or if it's brand new, if it's brand spanking new, brand new construction, or you're the second owner, something like that, you might not have to budget as much for repairs. So keep that in mind. It's really going to depend on the age of the home. It's like any of those rules. It's going to be a little bit flawed in nature, but it's a good starting point, and you should at least be setting aside something for potential repairs. Potential increase in utilities. Typically, when people move, they move up size. Not always the case. We call it right sizing when you don't. But potential increase in utilities. Your water bill is going to be higher. Your electric bill, gas bills, all that's going to be a little bit more expensive. And then how about HOA dues? HOA dues have been skyrocketing lately. Absolutely skyrocketing lately. The reason they've been increasing so much is because we had hail damage, a lot of hail damage in the last couple of years. And then we also had the Marshall fire up in my neck of the woods. I can see the fire damage from my house. So HOA dues. What happened is the insurance companies came out and said, hey, look, the insurance premiums along the front range have skyrocketed. Your HOA dues include insurance for the outside of the building. And we're going to have to increase our insurance cost to account for all the additional risks that's happened in the area. Marshall fire, hail damage. And HOAs have been scrambling. They're like, we have two options. We can either have a special assessment. Special assessments where they say, hey, our HOA dues are insufficient. We're going to collect an additional monthly amount or an additional upfront amount to cover the increase that we might have due to our insurance premium. Or they can increase your HOA dues. And I've seen multiple HOAs go both directions. One has been doing a special assessment. Another one has been increasing their HOA dues. It's very common to see both right now. With HOA dues, you want to find out how much are the HOA dues today. That matters. How much did they increase the last couple times that they've increased? You want to make sure you're budgeting all that in. You don't just need to protect your current version of yourself, but also the future version of yourself. If your HOA is constantly increasing the HOA dues, you're going to want to know about it before you buy into that property. HOAs are very common with condos and townhomes, much less frequently for single family. All right. So you decide you want to take the step. You want to get pre-approved. Oh, before I get into that, Kat, you got a question.
Yes, it just came in. What would you say is a good house emergency fund amount to try and hit for an old house and for a new house?
I love that. If I'm in your shoes and I'm budgeting to buy a house, I want to make sure a couple things. One, after I close on a house, am I going to have 6 months worth of expenses set aside after closing? Rainy day fund, right? If you know what was to hit the fan, do you have the means to survive for a few months before you found a new job, got additional support, whatever the case may be? So 6 months as a reserve account, I love that. I think that's smart. I think that's wise. If it's an older house, it's not uncommon to have to budget 20% of your housing payment towards repairs, unexpected repairs and maintenance. If it's a brand new spanking house, you might have to only budget 5%. Brand new house, like quite literally new construction, comes with warranties. So it's going to offer you a fair amount of protection. Okay. Like anything though, once those warranties expire is typically when they start to break. There's a reason they do it for as long as they do. So yeah, somewhere between 5% for new construction and 20% if it's an older home. I think that'd be wise and smart. Great question. All right. So pre-approval. You decided you want to take this next step. You want to get pre-approved. You would complete an application with the lender. It's going to go over to your work history, to your address history, social security number, birthday, asset information, how much do you have and who do you have it with? Pretty basic information you'll know off the top of your head. We will then do a credit pull. It is a hard credit pull. It's going to open up a 4-month window to buy a house. So once you get pre-approved, it opens up a 4-month window to buy a house. That's the time frame you'd be working with. We're going to be doing all that analysis I just talked about. What's your credit score? What are your debts? What are the adverse things on your credit report itself? What is your debt to income ratio? How much do you have available for a down payment and what kind of account? We're going to do all that analysis we just talked about. I'm going to be doing all that for you. Okay. Once we do that, then it typically is done same day or next day. It's really, really quick. Once we do that, we will be able to then issue a pre-approval letter. That pre-approval letter says, hey, great, you're pre-approved up to this price point. Okay. Once it comes time to actually make an offer on a house, I'm going to send you an updated letter specific to the address and price. I do not want to tell them you're qualified up to $500,000 if you're planning on making an offer at $400,000, because that seller is just going to come back and ask you for more money. Okay, so the initial letter is generic in nature for the higher end of what you're looking for. After that, we get you an updated letter specific to the address and price. Once you've been pre-approved, your next step is to start to find a property. That's the fun part. That is the fun part. Talking to me, unfortunately, is not the fun part. They make it as painless as it can. But talking about finances is not nearly as entertaining as actually starting to look at homes. Before you start to look at a home, you're going to want to talk to a real estate professional. Okay. If you don't have names and numbers for real estate agents, let me know. I only work with the best of the best. I'm more than happy to give you some names and numbers on that. But you need to work with a real estate agent. Highly recommend that you work with a real estate agent. For perspective, I used to have my real estate license, got my real estate license in 2008. I know financing better than I like to think anybody else. To this day, I still hire a real estate agent. There's this misconception that real estate agents really only help you like negotiate the price. That is so wrong. That is like a fraction of what they do. They get you access to homes. They have conversations with the seller's agent, the listing agent, to figure out what a decent offer would be to give you a leg up on the competition. They negotiate timelines. They negotiate closing itself, when and where is closing. They negotiate all the dates within your contract. They make sure that you're staying true to those dates, and so that you're not going to have to risk your earnest money, which we're going to talk about in a little bit here. So real estate agent does 100 different things during the process, not just that one piece. Kat, before I get into the rest of this, what do you got?
Yes. So the question is, how does the pre-approval process affect the fact that you do not need a mortgage? So I would say translating it to, do you need to get pre-approved if you have the funds available to get a mortgage? Or
If we're
to
offering cash for a
mortgage?
house, then you are in the wrong place, my friend. None of this is relevant for you. I'm joking. Some of this is relevant for you. The process actually from here on out kind of is relevant for you. But if you're paying cash for a house, you do not need to get pre-approved. If you are paying cash for a house, what you do need is a proof of funds letter. Honestly, it's like you submitting your bank statement to a seller to show, hey, look, I have the ability to buy this house cash. Congrats, that's great. You do not need a pre-approval letter. You need a proof of funds letter. They will not look at a cash offer that does not have a proof of funds letter. Either something from your wealth management advisor saying, hey, they've got sufficient funds to pay for this house, or a bank statement showing, hey, look, this is how much I have available in my bank account. They're going to need one of those two things to really review that offer. They're not just going to take your word for it that you have the means to pay for that house cash. They're going to want to see it, unfortunately. So yes, you do not need to get pre-approved. you do still need to get an agent, in my opinion. Let's pick up there. So when you're selecting a real estate agent, ask them for references. You are not insulting them. Okay, you are not insulting them. A real estate agent, a professional real estate agent, would be more than happy to give you some names and numbers of raving fans who would love nothing more than tell you how great they are. A good professional agent has no problem with that. Okay, so ask them for references. Hey, do you have a couple phone numbers, names, and phone numbers I could reach out to if I wanted to, see about how you operate and how things went with you? Yeah, no problem. Here's a few names and numbers. Also ask them about their experience. Ask them about their experience. Not just how long have they been doing this. Honestly, that doesn't matter too much. It matters some. I'm not saying it doesn't matter, but more importantly, is this a profession for them or is this a side hustle for them? So many people watch HGTV and then they decide they just want to go get their real estate license and start, doing their own fix and flips, that kind of thing. The average real estate agent in the entire USA does 1.5 transactions a year. 1.5 transactions a year. That should be a red flag. That means that this is a side hustle, right? If 1.5 transactions per year is the average for a real estate agent, that tells you a lot of real estate agents have a license and a lot of them are not doing any business. Okay. You want to find an agent that's doing, I would say at minimum, 10 transactions a year. 10 transactions a year is a pretty solid real estate agent. Some of the best are going to be doing like 24 transactions a year. That's really, really, really good. But I want to make sure that there's at least a real job for them. It's not just a side hustle. They don't just sell real estate on their own or work for their friends and family, but this is a true profession for them. So also ask them how long they've been in the area for. Just because they've been a real estate agent for 10 years, if they've got all that experience in New York, it's a completely different market here. So how long have you been in the area? Do you have people I can talk to or testimonials so I can see how you operate? And then how many transactions do you do on an average in a given year? 2023 is a little bit of an outlier, a little bit of a down year. So if they, didn't have a great year last year, I'm not holding that against them by any means. But the last couple, I think that would be a fairly good representative of how they do. Make the most of the relationship. Communicate clearly and often. That's any relationship, right? Not just with your real estate agent. Communicate clearly and often. Okay. Keep track of what you liked and did not like while you viewed homes and let them know. Like any relationship, you get out what you put in. Okay. The more you communicate, the better off your relationship's going to be. You are not bogging them down with details. You are not driving them crazy by being too picky. You are only helping them help you. They really don't know what's going on inside your brain unless you tell them. So be open, be honest, let them know what you did and did not like about a home. And then be wary of this, potential pitfalls. So this happens all the time. People get pre-approved. They're starting to look at homes. They see an open house. They don't have an agent yet, so they just walk into the open house. And they say, hey, look, this is a great home. I think I might want to make an offer. And they go and they start to work with the listing agent, the agent who has that listing. And then things quickly kind of deteriorate from there. So in Colorado, an agent cannot be an agent for both the buyer and the seller. Okay. It makes a lot of sense when you think about it. An agent cannot negotiate for both parties simultaneously. It doesn't work that way, right? You're either negotiating for one and against the other, right? There's no way to possibly negotiate for both parties. So in Colorado, you can become what's called a transaction broker. Transaction broker no longer has loyalties to either party. What they have loyalties for is the transaction as a whole. Okay. They are now negotiating for the transaction as a whole. For instance, if you want to make an offer on a house and you're talking to the listing agent and they decide to act as a transaction broker, they could give you a stack of information saying, hey, here's all the comparable sales data in the area. What price would you like to offer? They can't tell you what price to offer. That'd be negotiating. But they can give you the data so that you can come up with your own decision and make your own decision based on that. I have some agents that love being transaction brokers, love working for both, love working for the transaction because in their eyes, it's the easiest job in the world. The easiest job in the world. It's the easiest job in the world because they truly cannot work for either party. Their job is to hand documentation back and forth, get signatures, key at everybody closing. That's their job. Some people love it because it's so easy. Some people hate it because they cannot possibly separate themselves from their original client. So if you do this, if you are going to an open house and looking at properties and want to make an offer on that with the listing agent, ask them, hey, if I decide to make an offer on this house, what would happen? Would you become a transaction broker, or would you work for your client? And I'm now a customer. Customer means they have no loyalty to you at all. You are now gambling against the house, essentially. You got nobody in your corner. You are completely at the mercy of them. That's a very precarious situation to be. So if you are going that route, just make sure you're having conversations with them in advance. In Colorado, you can't be an agent for both. You could be a transaction broker, in which case you're an agent for neither. Or you could treat one party like a customer, no loyalty to them, and work for their own client. If you have your own buyer's agent going in, you don't have to worry about that. Your buyer's agent will take care of you. The seller's agent will take care of the seller. It's now up to the agents to hammer everything out. All right. So when you're looking at homes, you quickly need to discover what is negotiable and what is not. Okay. Everybody's got to make compromises, especially when you're buying like your first home. Very few people buy their forever home the first time, right? For me and my wife, it took us like 3 homes to find our forever home. We just had to slowly work our way up. So decide what is negotiable and what is not for your situation. Location, big piece of the puzzle. Does the school district matter? How about the commute? Is that negotiable at all? Yeah, I really wanted to live in the city of Boulder or city of Denver for convenience sake, but I'm willing to drive and commute a little bit if I have to. Great. You might open up a whole nother pool of properties if you can extend your commute just a little bit. Not coincidentally, the more convenient it is, the more expensive it is, right? So you might have to make some compromises when it comes to some convenience. Life stage, big part of the puzzle. Ranch style home. If you're getting older, you tend to prioritize or have preferences for ranch style homes. Single level living, kitchen, bedroom, all that's going to be on one floor. Nice and convenient. Don't have to worry about going up and downstairs. Don't have to worry about mobility issues as you get older. It's a little bit more convenient. Multi-level homes are going to be cheaper. They're going to be more affordable. You walk into a split level home, you immediately have to go upstairs or downstairs, right? Well, with the split level home, that's going to attract a younger pool of people that don't want that single floor living, people that want actually some more privacy and space. So ask yourself, again, do I have the ability to negotiate and be compromising on these kind of pieces? Large yard versus small patio, people immediately say, yeah, I want a large yard. Large yards come with a large amount of maintenance and your water bill is going to be extremely more expensive because you have to pay for all the lawn care during the hot summer months. So, my dogs love the large yard. You know who doesn't? This guy. It's expensive to maintain. I don't like lawn mowing. It's not fun for me. I don't enjoy it. So ask yourself those questions as well. Small patio, less maintenance, less privacy, less way to spread out. Yeah, ask yourself, what is your priority? New construction versus existing home. I think the next seminar I create is going to be simply on this topic. People immediately say, I want new construction. There's some advantages to it. There's also some significant disadvantages. So advantages of new construction, you don't have to live in somebody else's dust. That's great. You get to design the home, to pick from a different floor plan, pick the finishes you want in the house. You get more control over what that property looks like, right? That's an advantage. Another advantage, cheap insurance. Insurance companies love new roofs, new siding, new warranties. They love new warranties. So new construction is going to have lower insurance costs. Great. Downsides, taxes are going to be more expensive, almost guaranteed. It's most likely going to fall into what they call a special taxing district or a metro taxing district. When it falls in one of those districts, it means your taxes are going to be significantly higher. That is the community as a whole pooling their tax money to pay for the build out of the infrastructure of the neighborhood. Utilities, sewer, electrical wires, sidewalks, roads, they have to pay for all of that build out. Okay, so that's going to be more expensive. Property taxes on new construction are going to be more expensive. New construction, those homes tend to be closer to one another. Land is at a premium along the Front Range. Because of that, they're building homes almost on top of one another. You can reach out your window and touch somebody else's home. Also, it's going to be a construction zone for a while. Unless you're buying that last house, plan on having construction noise, roofers, bulldozers, all that going on in the neighborhood. Dust, dirt, construction sites are dirty. Immature landscaping, underrated, but important. Whenever you go into like a new construction neighborhood, you can tell immediately how new it is based on how old the trees are. Existing home has all the opposite. More expensive insurance, but cheaper taxes. Tends to have more privacy a little bit. The older homes tend to be a little bit further apart from one another. All things to consider. I like new construction, I really do. I tend to like it for those that can be in the house for a longer period of time. You don't want to be selling your new construction home and competing with the builder as you're trying to get out of the neighborhood. That's a precarious situation to be into, and I've seen multiple people caught in that trap. They buy a house as a first-time home buyer, you buy new construction, and then 3 years later, you're like, oh, I want to move on to our next home. Builder's still building out there. That's going to be a tricky thing. Why would they want to buy your house when they can just go next door and talk to the builder? Yeah, it's not very fun. So keep all of that in mind. I'm not against either one. There certainly are some pros and cons to think about. When you're viewing properties, bring a notebook. Keep track of what you like and do not like, make notes. Take pictures if you need to. Why would I need to take pictures? Well, you have your cell phone, right? So it's easy to do so. But not just that, the MLS pictures can be a little bit misleading. And when you're trying to remember what things look like, if you're relying on the MLS pictures, it's a little bit tricky. What you see might not be actually what the house looks like. They're very good with those photos. A tape measure. If you have specific furniture that you need to fit in, I've got a pool table, I need this much space. Great, bring a tape measure. You'd be surprised how few times you're actually going to walk into that home prior to closing. You walk in for your first showing. You might walk in if you scheduled a second showing, if you're lucky. Then you're going to make an offer on a house. You almost never see it more than twice prior to making an offer on a house. Sometimes you only see it once. Your inspection. Once you go under contract, you're going to schedule an inspection. You could go out to the home during that inspection appointment and view the house again. And then maybe your final walkthrough, day or two before closing. You might see the house only 2 to 3 times prior to actually closing on that house. So take your time with your showing. Bring a tape measure if you need to measure out any specific items, because you're not going to have very many opportunities to get back in that house prior to closing. Ignore easily replaced cosmetic features. The line you're going to hear a lot is paint is cheap. When they say paint is cheap, they don't just mean paints. They mean anything that's cosmetic, right? Flooring is very cheap, relatively cheap. Paint is cheap. Try to ignore all those cosmetic features. I bought an investment house a few years ago, and I looked at my agent. I was like, why is this property still in the market? Everything else is flying off the market. This one is still lingering. He's like, they don't like the color yellow. It was painted yellow on the inside, bright neon yellow. I agree, it's ugly. I was like, wait, really? That's it? Like, people didn't make an offer on the home because of the yellow paint? I can fix yellow paint. Not a problem. Yeah, quite literally, that's the only reason. It was on the market because nobody liked the color of the paint. It was just such a turnoff. People just walked in and walked out. Okay, I can fix that. Evaluate the storage areas. Again, you're not going to have very many chances to walk in that home once you decide you want to make an offer on it. So make sure you take your time evaluating storage areas if you need more space. Walk around outside and look over the exterior and listen to the neighborhood. My current house, my wife and I, we bought our forever home a few years back out in Erie. And once we moved in, I didn't even listen to my own advice. Once we moved in, I was like, honey, you ever notice the road noise? I was trying to say, road noise? No, not really. Like during the winter, when the air is dense and cool, you can hear Highway 287 in the background. It's not terrible. It's nothing that's going to, like, ruin our stay at our forever home. It still is my forever home. But it's stuff we didn't notice at the very beginning. And once we moved in, we did. And that brings me to one other part, which is you need to view the property multiple different times. If you do your first showing at noon on a weekday, try to schedule your second showing for the evening. The idea being, you might not hear road noise in the middle of the day. You might hear it at night during rush hour. Or if you're buying in a condo complex or a townhome complex, the parking lot might be empty during the day. How are your neighbors? Are they loud? You don't really know. At night, you're going to get a little bit of a better representation of, is there adequate parking? Is there adequate space? Is it too loud in the complex as a whole? Try to view the property at different times of the day. It'll give you a different take and a different sense of what the property is like. So when you go under contract on the property, you're going to do a couple things right away. Number one is you're going to schedule your inspection. The second thing you're going to do is you're going to drop off your earnest money. Earnest money is a deposit you make at the very beginning to show that you're proceeding in earnest. That's where it gets its name. It shows that you're proceeding in earnest. It's typically around 1% of the sales price, plus or minus a little bit. If you're buying a $500,000 home, it might be somewhere between like $5,000 and $7,500, somewhere in that area. Okay. A $300,000 home, yeah, $3,000 to $5,000, somewhere like that. So have that money at the ready. You might not have to have all your money in a liquid checking savings or money market account, but you need to have at least enough for that earnest money, because that is a check you're going to write at the very beginning. You deposit that money with the title company. We don't typically use real estate attorneys in Colorado. We typically use title companies. You're going to deposit that money with the title company. It's your agent's job and my job to make sure that you do not lose that earnest money. In Colorado, it's very easy to protect your earnest money. It's a very buyer-friendly contract. Okay, so if you don't like your inspection, cancel. You get your earnest money back. Don't like your appraisal, cancel. You get your earnest money back. Loan terms deadline at the buyer's sole subjective discretion. If you do not like the terms of your loan, you can cancel. You can get your earnest money back. Okay, it's your agent's job and my job to make sure that you do not lose that earnest money. Since I've been doing this, I've only seen earnest money sacrificed one time. It was somebody that was buying a house sight unseen. They had quite literally never seen their house. And they did the final walkthrough the day before closing and saw the house for the first time. They walked in and they said, yeah, I can't live here. And they sacrificed the earnest money. They walked away from like a $25,000 earnest money check. Kind of wild. But then again, if you have $25,000 to lose for earnest money, you're playing with funny money at that point. It doesn't even matter. So yeah, keep that in mind. That's what earnest money is. That's who it goes to. The other thing you're going to do right away, like I said, is your inspection. You're going to schedule your inspection. There's a couple things you need to be aware of along the Front Range. Okay, number one is radon. Radon is a radioactive gas that seeps in through the foundations in Colorado. It's not just in Colorado, it happens all over the place, but it's especially a problem in Colorado. If you have a house with a basement, you need to test for radon. It's extremely cheap to test for. You can even buy like a do-it-yourself kit at like Home Depot or Lowe's, less than $100. And it's much more expensive to mitigate. To mitigate it, you have to install a fan that runs through your house. So it'll like pump air from the basement up out of your house. And that could cost several $1,000s to install a radon mitigation system. So cheap to test for, expensive to mitigate. If there's not currently a mitigation system, test for it. Okay. Yeah. Bentonite. Bentonite is an expansive clay in our soils along the Front Range. You'll see some areas that are completely decimated by structural repairs. That's a place where they had a lot of bentonite in the soil. And there are ways that builders can mitigate some of the risk. They can have what they call floating floors, where the floor is automatically built so that it has some leeway for expansive clays in the soil, and it will not immediately cause structural issues within the house. They're doing exactly what they're supposed to do, which is float. Okay. There's also slab on grade, where they literally pour the concrete directly on the ground. Yeah, that's more of an instance of potential for structural repairs being needed. So your inspector, your bare bones inspector, they typically will test for radon if you let them know. They'll do their inspection. And then they'll let you know if there's any indicators that you should be paying for something else. They might notice cracks in the foundation and say, hey, yeah, you really need to get a structural engineer out here. I wouldn't say just go straight for the structural engineer unless you see obvious signs of issues. Your home inspector will let you know if it's going to be warranted or not. Okay. Mold. Mold did not used to be an issue in Colorado at all. We're a dry climate. Mold likes water. But after the flooding that occurred in 2013, we started to notice mold issues popping up more and more frequently. Again, your home inspector will let you know if there's telltale signs of structural issues or mold as well. Hey, we saw these black spores on the wall. You really need to get a mold test done as well. So do your basic inspection. I'd throw on radon. I'd definitely throw on a sewer scope. For that same expansive clay reason, it's very cheap to do a sewer scope. They'll actually run a camera down through your sewer scope to find out if there's any roots infiltrating your sewer lines. That can create issues, or any bulges. That's also a problem. All stuff that they're looking at, and all stuff that's related to the bentonite in your soil. So basic home inspection, test for radon, do a sewer scope, always recommend that. And then your inspector will let you know if there's any signs of structural or mold that they might have to test for. You can go kind of crazy with an inspection. You can do allergy tests if you're really sensitive to allergies. You can do an infrared test where it'll check behind your walls and see if there's any moisture behind your walls of any sort. You can do meth tests, testing if your house was ever used as a meth lab. Again, you can kind of go crazy with it. So special considerations for condos. A lot of condos in Colorado, not as much as some areas, but plenty. Again, as I mentioned, revisit in the evening when the parking areas are full. You're going to get a completely different sense of your house. Same thing with your neighbors. Middle of the day, if you did a showing, you might not notice any noise with your neighbors because everybody's at work. At night, yeah, you're probably more likely going to have some noises that you're going to hear. Am I moving out of a house or not buying a condo just because one of my neighbors is a little noisy? No, I'm kind of hoping for the best, planning for the worst. Planning for the worst is that they're going to stay a lot around, so I want to make sure I can live with it. But hoping for the best, yeah, they can move on. They might sell their place or rent. So maybe they're renting right now and they're just going to move on at the end of this, school semester. We just don't know. So I'm not necessarily ruling it out, but if all my neighbors are noisy, yeah, I've got a little bit of concern. It's probably more of an issue with the property than anything else. Common areas, are they well maintained? You're paying HOA dues, homeowners association dues. You want to make sure that your money is going towards a purpose that is worthwhile. Make sure the property is well maintained. Make sure you're going to use the amenities that the HOA offers. I've had people buy before into a complex with a pool and a movie theater and tennis courts, and they don't know how to swim. They have no hand-eye coordination, and they get nauseous whenever they watch a movie. Like, why are you paying for somebody else's enjoyment of all those facilities when you're not receiving any of the benefit? So ask yourself, are you going to use the benefits of that property? Cannot emphasize this enough. This is dull. This is boring. You need to do it. Okay. Whenever you buy into an HOA, you need to review the rules, fees, and regulations carefully. You need to make sure that there's nothing in those HOA covenants that is going to make it so that you cannot enjoy your property. I've had numerous people, not just one, numerous people buy into condo complexes just to find out that the limitations on renting their property out once they moved on were too restrictive, or they found out that they couldn't have the number of pets that they currently have. I had one person buy into a complex. They allowed for one dog up to 75 pounds. They had 2 dogs, and they now are in a really bad situation of either having to sell their house or get rid of one of their pets. My pets are my family. I love my dogs. That would absolutely be crushing for me. So don't put yourself in that situation. Review the rules carefully. Now, there's one other special piece about condos. So after the housing bubble popped, 2007, 2008 popped, the government blamed 2 things. One, loose lending restrictions, which is why Kat and I both have a job, because it's far more difficult to do this job now. I joke that after the housing bubble popped, lending got rather boring. By that, I mean all these kind of quirky loan features disappeared. It was way too easy to get a loan. Those quirky loan features disappeared. And now it got very difficult to do mortgages after the housing bubble popped. It's slowly gotten better and better and better. The pendulum swung. Way too easy to get a loan. 2008 happens. Way too hard to get a loan. And now it's swinging back towards the middle. Okay. So they blame loose lending restrictions. They want to make sure lenders are doing their due diligence. And 2, they blamed condos. They found out that when one condo gets foreclosed on in a complex, it decreases the value of all the other units in that complex, because now they have to sell at a discount to compete with that distress sale that happened quite literally next door. So the government said, hey, look, we are still going to lend on condos, but the condos have to meet some very specific requirements. We now have to find out, anytime you buy into a condo, but not a townhome, only a condo, we have to find out if your HOA meets these requirements or not. So let's go through these rules real fast. So 0. The complex cannot be in any litigation. That means the HOA cannot be suing somebody or being sued. Usually, if there's litigation, it has to do with building defects. The HOA, of which you now belong if you're buying in that complex, does not like the practices that the builder had when they built out the property. We see drainage issues where they didn't have adequate drainage options, so the water started to seep into units. We've seen a mixture of materials. Sometimes very beautiful units will have brick with like vinyl siding with like tin or aluminum, and unfortunately, when all those materials mix together, they don't always play they don't always play nicely together. So moisture can possibly get behind one component or the other. It can create issues. So if the HOA is suing anybody, it's going to be non-warrantable. Non-warrantable means it does not meet these criteria. It's going to be non-warrantable due to litigation. Maybe it's also a condo-tel. We don't see that along the Front Range, but we do see those up in the mountains. Because the mountains are part of the Front Range. Condo-tel is a condo complex that has some features of a hotel. Okay, you walk into a condo complex and you're like, this is kind of interesting. Why is there a front desk? You can literally walk up to the front desk and say, hey, look, is there any units available tonight? And they'll say, yeah, we're renting out units by the night. That's telltale sign of a condo-tel. They have short-term rental agreements, or they might have room service, less common, or they have housekeeping staff, very common with a condo-tel. They might have a concierge desk, all telltale signs of a condo-tel. Government does not want to be in the business of commercial financing of any sort. They want to be in the business of residential. In their eyes, condo-tels blur that line. Okay. 15. The complex cannot have 15% or more of the units be delinquent on HOA dues by 60 days or more. That used to be a problem when it was 30 days. Now that it's 60 days, this rarely comes up. Okay. 20. The complex cannot have one owner who owns 20% or more of the units. Okay. Their concern there is if that one homeowner got into financial trouble, they might flood the market with a whole bunch of units. And if they did that, it's going to drag down the value of your property. They don't want anybody to be at the mercy of any single individual. So no single owner can own 20% or more of the units. 35. Complex cannot have 35% or more of the square footage be commercial. Why would Fannie Mae and Freddie Mac care about that? Well, they're in the business of residential financing, number one. Number two, commercial is more volatile. Commercial is way more volatile than residential is. And now that I mention it, you'll start to notice it a little bit more. Have you ever driven past like a storefront and it's been vacant for not 1 month, not 6 months, not 12 months, but like 18 months, 2 years? Yeah, that's the concern. Who would want to buy a property that's right above vacant space? It's a little bit unnerving. You don't know what's going to go in there. It could be a great shop, or it could be a restaurant and with kind of noxious odors. It could be, we're in Colorado after all, a marijuana shop, also potentially with noxious odors, if that's not your thing. It could be a bowling alley. Talk about noxious, that's going to be loud and annoying. Could be a gun range for all you know. Fannie Mae and Freddie Mac do not want to tie their fate to commercial performance. They are worried about the unknown of not knowing what's going to be going in there. So they limit it to 35% or less. And then sometimes 50. If the purchaser of the unit is an investor, at least 50% of the units must be owner occupied if you're putting less than 25% down. This only applies if the person that's buying it is an investor. A lot of lenders will tell you differently. A lot of lenders will tell you we absolutely care about what the owner occupancy ratio. If they do, hang up the phone and call us, okay? That lender has what they call an overlay. An overlay is a requirement that's overlaid upon the government's requirements. So Fannie Mae and Freddie Mac have their requirements. An overlay is the bank and credit union saying, hey, we're going to have our own limitations above and beyond that. Elevations does not have any overlays there, so don't worry about that. If you get this answer, hang up the phone. If you're living in the property, you're either going to keep the ratio the same or you're going to improve it. Either way, we're all good with it. Okay. So keep these things in mind. Now, people always ask the question like, how do I know when I'm looking at condos whether or not it meets these requirements? Typically, you don't. You might see it advertised as this is a non-warrantable condo. And if they do, it's very common that it's because of an obvious reason like litigation. Most of the time, though, you don't know. Unfortunately, most of the time, though, you do not know. So ask us. We keep a list. We keep a database of condo complexes, and we do more loans in Colorado than any other financial institution. So there's a good chance we have done a condo in that complex before, and we could let you know. Otherwise, we will find out as soon as you're under contract. It's kind of the wild, wild west in Colorado. You go under contract and then you start asking questions. So, all right. So review real quick. You've spoken with the lender. We reviewed your 3 C's, the type of property you're trying to buy, your credit, your capacity, which is your down payment, your debt to income ratio. We've gotten you formally pre-approved. You've spoken with some real estate agents. You've figured out who you want to use. And now you've been pre-approved and you have your real estate license up. Now you're ready to start looking at homes and ultimately making an offer on a house. Once you find a house you want to make an offer on, your real estate agent's going to help you with drawing up the contract. Okay. They're going to discuss the offer amount. What's a competitive offer? They're going to be filling out the listing agent to figure out what a good competitive offer would be. They're going to find out if there's any options for seller concessions. Maybe the house has been on the market for a while. Maybe that seller wants to pay some of your closing costs. That's what a seller concession is. It's a seller paying for some of your closing costs. Okay. So maybe that's an option. Your agent's going to work on that. They're going to present you with the contract. In Colorado, it's a standard contract. Every year it gets redone. Every year it gets updated, but it's a standard contract. Your agent's job is to fill in all the blanks within that contract. Okay. You'll sign it, and then the agent will submit it along to the seller's agent. And with any luck, have it signed. More often than not, what's going to happen is they're going to issue what's called a counteroffer. Counteroffer is where the seller says, we like this, except for these following pieces. We want you to update these following pieces. So they will issue a counteroffer. Once you sign that counteroffer, you are officially under contract. Get prepared to submit your earnest money. You're going to have to drop that off within quite literally a couple days of you going under contract. And then I'm going to get you an updated pre-approval letter. Like I said, specific to the address and price. I do not want to tell a potential seller that you're qualified for any more than you're offering. I want to keep the leverage intact as much as I possibly can. Once you're under contract, let us know. We need a copy of that contract and counter. We're going to send you some updated loan numbers. We're going to review your loan options with you, figure out which loan option is going to be best. I will then advise whether or not I think it's smart to lock in your interest rate or whether I think it's smart to float. Float, the interest rate means we're at the mercy of rate fluctuations until you lock it in. Once we lock it in, you are protected from rates rising during the process. I can tell based on what's going on with the bond market, what's likely to happen to rates the next day. I am in the bond market, mortgage-backed securities market, quite literally every single day, seeing exactly what activity is going on. I'm trying to look at trends and figure out where rates are going. Last week was really good for rates. This week so far has not been great for rates. Like right now, if you were saying I'm under contract, I'd say probably need to lock it in before things get worse. So it just depends. We look at the market, we figure out exactly what's going to be your best option. I'll send you loan options. That's where we get into the points conversation. Does it make sense to pay discount points or not? I'm glad a member mentioned that earlier. We're going to look at all of that once you're actually under contract. Rates will change quite literally Monday through Friday. Whenever the markets are open, the rates are going to change Monday through Friday, 52 weeks a year. So I want to see what's going on. Does it make sense to pay points or not? We're going to do all that analysis with you. We're then going to send you some loan disclosures to sign, and then you're going to provide updated documentation to us. 2 years of W-2s, 30 days of pay stubs, 2 months of bank statements. We're going to send you a nice list of exactly what we're going to need from you. Once you're under contract, you worry about scheduling the inspection. We worry about scheduling the appraisal. Okay, so the appraisal gets the appraisal fee. It gets paid to an appraiser. Their job is to make sure really 2 things. 1, the property is worth what you're paying for. That's their primary concern. And 2, to a much lesser concern, is there any obvious health, safety, or livability concerns within that property? Has to be rather obvious. Okay, has to be an obvious health, safety, or livability concern. Holes in the roof, exposed wiring, exposed plumbing, settling issues such that somebody might trip and fall on the property. Has to be pretty obvious for the appraiser to call it out. Okay, so what is it? It's a report that reports on the value of the property and the condition of the property. Who does it? We have a panel of approved appraisers. Okay, we spend a lot of time and energy vetting our panel of appraisers. We do not want an independent contractor, and that's what appraisers are. They're independent contractors. We do not want an independent contractor ruining our reputation. So we try to keep our panel of appraisers really buttoned up, those that are the best at what they do. We also limit how far they can go. We try to limit to only a couple zip codes that they can operate inside. We do not want an appraiser going from Colorado Springs to Boulder or Boulder to Colorado Springs. Completely different markets. We want somebody that knows the area quite well. If it comes in low, you have a few options. Number 1, you were just granted more leverage to possibly negotiate a lower sales price. That's a frown upside down. Okay. Hey, we're under contract at 400,000. The appraisal came in at 375. Okay. Well, you could theoretically take that appraisal back to the listing agent and say, hey, we want you to reduce the sales price to 375. That's what the house appraised for. They could say yes. They could say no. If they say no, you could bring additional funds to closing to make the transaction work. So you could do what's called an appraisal gap, where you simply bring additional funds to keep the transaction intact. You could also cancel. The appraisal comes in low. You did not have any terms in the contract that remove that possibility. You could simply cancel and say, hey, this house didn't appraise. We're going to move on to a different house. Thank you so much. We could also go ask for a reconsideration of value, ROV, reconsideration of value. That's where we say, hey, look, Mr. or Mrs. Appraiser, we think you missed something. I don't know if you saw, but there was this one sale that occurred a few doors down. It was a private sale, so it didn't make its way into the MLS. But hey, what do you think about this? The appraiser is required to review that additional data and then decide whether or not it warrants a change in value. Appraisers are human. Sometimes they miss stuff. If that happens, we can request a reconsideration of value. If it comes in high, you are the only person to know about it. Okay. When we get that appraisal and it comes in high, congratulations, you're walking into more equity in that house than we originally thought. That's a great situation to be in. You are the only person that knows. I do not want to let the listing agent know that our house appraised high, because it's just going to give them more leverage to maybe dig in their heels on inspection or whatever the case may be. So that data is data for you and you only. We do not tell anybody else the specific value. We will send out like a generic email that says appraisal in at value. That just means we're good on value. It could have come in at contract price. It could have come in above. Either way, appraisal in at value, we're good. Don't worry. Keep things moving along. Once you do get under contract, there's a few pitfalls to avoid. So make sure you're not applying for any new loans. I mentioned that, and people are like, well, yeah, why would I do that? Well, oddly enough, when you're buying a house is exactly when you would want to apply for new loans. You buy a new house, well, now you need a new washer and dryer. So you might be looking at Home Depot on their President's Day sale and saying, hey, maybe I do want to take advantage of some better offering. Lenders are going to update your credit report 7 days prior to closing. It's an update to your credit report. It's not a brand new credit report. We're not going to get a brand new score. You're not going to worry about, your loan getting denied because something might have shown up there. But when we update your credit report, we are looking for a couple things. One, how have your account balances shifted? Is there any additional payments or higher payments that we need to take into account in the final debt to income ratio calculation? And 2, has anybody else checked your credit? And if so, why? we want to find out, oh, hey, Home Depot did check their credit just a few days ago. Why did they do that? Oh, well, I did get a new credit card. It used to be the cool thing where a home buyer would drive a new car to the new house closing. And then the government started to ask, hey, did we factor in that new car loan payment and then they bought this house? The answer was inevitably no. So now they have lenders do a credit update 7 days before closing to make sure you haven't gotten any new accounts and you haven't changed your balances drastically. So keep an eye on that because we will find out. And if we're scrambling to add a new account to your credit report 7 days before closing, it can get a little bit ugly. So talk to us, be upfront and truthful with your lender. We're going to find out otherwise. Don't make any unnecessarily large purchases, withdrawals, or honestly, what I care about more, deposits. Anytime there's a deposit for more than 50% of your typical pay, I have to find out where that money came from. It can be a total nightmare. Okay. Sometimes it's very easy. Oh, well, I transferred money from another account. Perfect. Show that one transfer bank account. We're good to go. I've had some people that sold a lot of furniture at like a garage sale and they deposited a lot of cash. If it's more than 50% of your pay, I have to find out where it came from. Unfortunately, if it's cash, there's no paper trail. The government's really worried about somebody selling like drugs or doing something illegal and receiving money for it and now using that money to buy a house. That's really what the government's worried about. And I've also had people try to get really creative and say, oh, well, 50% of my pay is $1,000. So I'm just going to do, that's a really bad example, $1,000, whatever. They're going to do multiple smaller deposits that add up to that amount. No, my underwriter is immediately going to see that and immediately going to call it out. There's a lot of underwriter discretion there. So again, just be upfront, honest, talk to us. Where there's a will, there's a way. There's typically a way to document whatever we need to document. So just talk to us, okay? Please provide the documentation as quickly as possible. Once you go under contract, we say, hey, we'd like to see this documentation back within 3 business days. We may or may not have more time than that, but anything you can do to help us along the way is going to be very helpful. Loan approval process. All right, so we're going to prepare your file for the underwriter. We're going to get that documentation, pay stubs, W-2s, bank statements, and then we're going to submit it along to the underwriter. The underwriter's job is to make sure that what we submitted, what we put in front of them, matches the government's guidelines with regards to what is needed. Okay, their job is to interpret the guidelines, make sure that what we submitted to them checks those boxes. Okay, the underwriter is going to review it, ensure it complies with the guidelines, and then they're going to issue what they call a conditional approval. Conditional approval is, hey, your loan is approved pending. We still need the appraisal. We still need you to finalize your insurance policy. Or, oh, hey, maybe we forgot one pay stub. We need one more. That kind of thing. Okay, you'll supply that additional documentation to us. We'll submit the file back to underwriting for final sign-off. Once we get final approval, we're going to work on the final figures for closing. So us and the title company are going to work to resolve those final figures. We're then going to send you those final figures with the final numbers down to the penny. Okay, exactly how much you need for closing. You're going to have to send those funds to title in either the form of a cashier's check or a wire. We'll let you know which one. Some title companies allow both. Some title companies only allow a wire. It just depends on the title company. We'll let you know what the title company's preference is. We'll review those final numbers with you, make sure you don't have any questions. And then, like I said, you'll wire your funds to closing or get a cashier's check. Closing will be done almost always at the title company itself. You will physically go to the title company. You and your agent will sit on one side of the table. The sellers and their agent might sit on the other side of the table. More and more frequently, they're closing separately, so they might have a separate closing time. Title rep will sit at one end of the table. I'll sit at the other end of the table. Okay. The title rep's job is to pass documentation back and forth, explain exactly what you're signing, have you sign it, and then they notarize it and record it with the county after closing. So they will handle the physical act of closing itself. Okay. Closing is done at the title company. If you electronically sign your documents ahead of time, closing will be as short as like 20 minutes, maybe 30. If you don't do any of that ahead of time, plan on about an hour. Okay. It's the wild, wild west. Like I said, you go under contract and then you start asking questions. It's the wild, wild west also insofar as once you close, you get keys to the house. You turn over your money, you get keys to the house. Everything happens the day of closing. And that is it. You have officially bought a home. Congratulations. Questions? Couple minutes to spare. Questions? Here's all my contact information. Take a screenshot of it. Write my cell phone down. However I can help you, let me know. If you think of questions, which inevitably will happen like once we end this broadcast, let me know. Let me know. I love questions. I love the education part of this process. It really is my favorite part. So if you have a question, please let me know. However I can really be useful and helpful to you. Kat, any other questions that you see?
I do not have any other questions on my side.
No other questions. Well, thank you all so much for spending your lunch with me. Maybe there's one. Let's see.
Oh, yep, just came over. Is there any benefit to putting down 10 to 15% and then quickly paying down enough to get rid of PMI as opposed to paying 20% down immediately?
Not really. Not really. Interest rates are going to be really the same. Whether you do 5%, 10%, 15, 20% down, interest rates are going to be very, very, very similar. People are always surprised by that. From a lender's perspective, if there's mortgage insurance, it's mitigating the risk. It's really protecting the lender all the way down to that 20% threshold. So short answer is no. And there's some pros and cons. Like we'll talk about various different options. Like you may not know exactly how much you're putting down until you do your inspection. You might do your inspection and find out, oh, well, we have to pay for a new furnace and a new AC unit. I need to hold on to some more funds than I was originally intending. Great, no problem. We can certainly tweak that. We can tweak the loan amount up until 10 days before closing. Great question. Love it. And it looks like that is it for questions. Well, thank you all again so much. Appreciate you all. If you have any other questions, do let us know. However, we can be useful and helpful to you. Thanks. Bye.